Okay, I want you to picture the scene today. It is this morning, Friday, February 20th, 2026. You're sitting at your desk, maybe you've got your second cup of coffee, and you pull up the market data on your terminal. And if you happen to be watching the real estate tech sector, you probably just spit that coffee right out onto your keyboard.
Oh, yeah. It was a serious wake-up call, wasn't it?
That is definitely putting it lightly.
Yeah.
We're looking at Opendoor Technologies today, ticker symbol OPEN. And the board was just lighting up green. The stock surged over 16% overnight.
Right.
And this is a company that, let's be totally honest here, for the last 3 years, the market had basically just left for dead.
Dead is really the only word for it. I mean, I think a lot of smart people, too, had completely written them off. They saw them as this inevitable casualty of that brutal post-pandemic housing crash.
Yeah, the narrative was just set in stone.
Exactly. The story was they buy houses, they hold them, the market drops, they lose a ton of money. End of story. Move on to the next stop.
The ultimate bag holder narrative. But looking at the stack of research we have for our deep dive today, we have a lot to get through. We've got the Q4 2025 earnings report that just dropped yesterday.
Yeah.
We have this really fascinating deep value analysis report.
Yes.
And we also have some, frankly, terrified notes on the new geopolitical landscapes, specifically involving some new tariff.
And when you take all those sources and put them together, that whole dead home flipper narrative starts to look, well, wrong. Or at the very least, significantly outdated.
Right. So that is our mission for this deep dive. We are going to answer the big question. Can a company that lost billions with a B, billions of dollars buying houses during the interest rate freeze of the early 2020s, actually pull off a refounding?
I love that word, refounding. We are going to be discussing that a lot today. Because they aren't just trying to patch up the business, they're trying to fundamentally change what the business actually is.
Going from real estate investor to software company, which, sounds great. Software margins are sexy. Real estate margins are dirty and difficult. But it's not going to be a smooth ride at all. And to tease where we are heading, by the end of this hour, we're going to look at 2 totally different valuation models for this company.
And the spread on these is just wild.
It blew my mind. One model says Opendoor stock is worth $4, basically worthless.
Huh.
But the other model,
$150. So
$4 or $150? That is the massive gap we are dealing with.
it really is the difference between total bankruptcy and becoming the Amazon of real estate. And that difference comes down entirely to whether you believe the story we are about to unpack.
So buckle up. We are going to look at the Opendoor 2.0 pivot, the management team betting their own personal fortunes on this, and the massive risks, like a literal new trade war that could ruin everything before it even gets off the ground.
Part 1, chapters 1 to 3. Business, management, and financials.
Chapter 1.
Business understanding. So to really grasp why today's huge 16% jump matters, we have to understand the machine itself. How does Opendoor actually make money? And probably more importantly, how did they lose so much of it in the first place?
Right. We have to look at the old way, the legacy model.
Exactly. This is the classic iBuyer model that made them so famous back in 2018 and 2019. At its core, that legacy model was basically high-tech house flipping. But on a scale that is honestly hard to comprehend, Opendoor would go out and use massive amounts of debt. We are talking billions of dollars in giant credit facilities to buy homes directly from everyday sellers.
Okay, so let's put ourselves in the user's shoes. I want to sell my house. I go to the app. They give me an offer. I say yes. Opendoor just cuts me a check right there.
Correct. And the moment they cut that check, Opendoor owns your house. It sits physically on their balance sheet as an asset. But that means they are now fully responsible for it. The insurance, the property taxes, the utilities, making sure the lawn is mowed.
All the holding costs.
Yes, and crucially, they are paying high interest on the massive loan they used to buy it from you.
So the clock is ticking immediately. Every single day eats into the profit.
The clock is ticking extremely loudly. They would then do what they call light renovations, put in some new carpet, paint the walls, maybe fix some drywall, and then put it right back on the open market. The entire goal was to capture the buy-to-sell spread.
Which is really just the difference between what they paid me for the house and what the next guy pays them for it.
Minus all those holding costs and repair costs we just mentioned. Now think about it. When home prices are naturally going up 10% a year, this model makes you look like an absolute genius. You buy a house for $400K, you wait 3 months, and suddenly it's worth $420K. You made money just by breathing.
But when the music stops.
When the music stops, you are left holding a very heavy bag. And that is the fundamental structural flaw of the legacy model. It is incredibly asset-heavy. You are carrying physical inventory that can depreciate in value. If the real estate market turns downward while you are holding $1 billion worth of homes, you aren't just losing your profit margin, you are losing your principal. You are bleeding out cash.
Which is exactly what we saw happen in 2022 and 2023. We had the great interest rate freeze.
Yeah.
Mortgage rates went from roughly 3% to 8% seemingly overnight. And the value of those homes Opendoor was holding just plummeted.
It was a complete bloodbath for them. And this is the crucial part, that trauma is exactly what birthed Opendoor 2.0. This is the massive pivot that investors are celebrating today with that stock surge.
The shift to the marketplace.
Yes. They are moving away from being the buyer of first resort to being a marketplace platform.
Okay, we need to define marketplace in this context because every single tech startup calls themselves a marketplace these days. Uber is a marketplace. Airbnb is a marketplace.
Yeah.
What does it mean for Opendoor?
The Airbnb comparison is actually perfect here. Think of it this way. In the old model, Opendoor was the hotel. They owned the physical rooms. If nobody stayed in the room, they ate the cost and lost money. In the new model, they want to be Airbnb. They want to facilitate a transaction between a seller and a buyer without necessarily having to own the real estate asset themselves.
And the absolute crown jewel of this new strategy is this program called Cash Plus. I was reading through the Q4 report, and the growth numbers here are just wild. By late 2025, Cash Plus accounted for 35% of their total weekly transaction volume.
That 35% figure is arguably the single most important number in the entire earnings report. Because Cash Plus is the thing that solves the existential risk problem.
Break down how it works for me.
Here is the flow. You still come to the Opendoor app to sell your house. Opendoor still gives you a cash offer, which gives you that ultimate certainty you want. But, and this is the big shift, their primary goal behind the scenes is to find a third-party buyer to take the house immediately.
A third-party buyer like a regular family, or like a Wall Street investor.
It could be both. It could be an institutional landlord like an Invitation Homes, or it could be a retail buyer who just wants to live there. Opendoor effectively backs the offer with their own cash to make sure the deal gets done for you, but they pass the physical house through to the final buyer almost instantaneously.
So they don't hold the house at all?
Ideally, no. Or if they do, they hold it for days rather than months.
Wow, that changes the fundamental math completely.
Completely. Instead of making money on the price spread and risking a massive loss, they make money on a service fee. They collect a fee just for facilitating that seamless sale. It is a high-margin business, it's capital light, and it doesn't require billions of dollars in expensive bank debt to function.
So it is moving from heavy investing to purely facilitating. It really is software economics versus construction economics.
Exactly. And that right there is why Wall Street is suddenly waking up. If Opendoor is a software company that connects home sellers to home buyers, it deserves a significantly higher valuation multiple than if it's just a giant, risky house flipping fund.
That makes total sense from the company's perspective. It saves their hide. But let's look at the customer side. Why is this actually good for the everyday person? I mean, I have sold a house the traditional way with an agent. It is a nightmare. Is that the specific friction they're solving?
That is the entire value proposition. We sometimes get so used to the status quo that we forget how archaic selling a home actually is. Think about your own experience doing it.
Oh, please do not get me started. The staging alone? We had to rent neutral furniture. We had to obsessively hide the dog bowls and the kids' toys every single time someone wanted to do a showing. And the open houses, just having total strangers walk through your bedroom, opening your closets, it felt incredibly invasive.
It is incredibly invasive, and that is just the physical annoyance. What about the financial uncertainty?
The financing fall-throughs. That actually happened to us on our first house. We accepted a great offer, we started packing, we were ready to move, and then 3 long weeks later, the buyer's bank called them and said, "Oops, sorry, we aren't approving the loan after all." We were instantly back to square one.
That right there is the core pain point. The legacy real estate system is deeply broken. It's slow, it is highly uncertain, and it is incredibly emotional. Opendoor is selling one thing: certainty. You get the hard offer right on your phone, you pick your exact closing date, you skip the awkward showings, and you completely skip the financing risk falling through.
And people are really willing to pay a premium for that convenience.
They absolutely love it. Just look at the Net Promoter Score, the NPS. In the report we have, Opendoor's NPS is hovering right around an 80.
For some context, for our listeners who maybe don't track corporate NPS scores, what is a typical real estate industry score?
A typical bank or a cable company or a traditional real estate broker is usually sitting way down in the 20s or 30s. And 80 is truly elite. That is Apple territory. That is Costco brand loyalty territory.
So people aren't just tolerating it. They actively like using the product.
They do. And that level of brand loyalty forms a massive competitive moat. Opendoor has effectively become the Kleenex of iBuying. When someone sits down and thinks, I want a quick cash offer for my house, they don't Google the phrase institutional home buyers. They just Google Opendoor.
But they were the only ones trying to do this, right?
Mm-hmm.
I seem to remember Zillow, the absolute giant of the real estate internet, trying to do exactly this with Zillow offers.
Zillow did try, and it goes down as one of the most spectacular business failures of the last decade. They lost hundreds of millions of dollars rapidly and had to shut the whole program down in complete defeat back in 2021.
So Zillow is out. Redfin is out.
OfferPad is still around playing in the space, but they are much, much smaller. Opendoor is effectively the last major player standing in the dedicated iBuying space. Depending on exactly how you measure the metrics, they have between 67% and 90% market share.
That is pure dominance. But dominance in a completely frozen market doesn't really mean much, right? We have to talk about the macro environment. We were sitting here in February 2026. The last 3 years have been undeniably weird for housing.
Weird is a very gentle understatement. We all lived through the Great Lock-in effect. When the Fed jacked up rates to fight inflation, millions of Americans found themselves sitting comfortably on 3% mortgages.
Right, and nobody in their right mind is going to sell a perfectly good house with 3% mortgage just to go buy a new house with an 8% mortgage. You'd be doubling your monthly payment for the same house.
Exactly. So existing home inventory just vanished overnight. The entire market froze solid. But looking at the late 2025 and early 2026 data in these reports, we are finally seeing the real thaw. Mortgage rates have stabilized near 6%.
Which is obviously still double the old pandemic rates, but at least it is stable. People can do math again.
Stability is everything because it allows for life planning. People are accepting 6% as the new normal. Life marches on. People get divorced. They have children. They get relocated for new jobs. They eventually have to move regardless of the rate. The freeze is naturally ending.
And you also have a major demographic shift playing out right now, too. Gen Z is firmly entering the home buying chat.
Yes, and Gen Z fundamentally does not want to sit in a stuffy RE/MAX office drinking stale Keurig coffee while signing paper documents. They want to do absolutely everything on their phone. They trust software applications more than they trust commissioned salespeople. That macro shift plays directly into Opendoor's digital firsthand.
Speaking of commissioned salespeople, we cannot ignore the elephant in the room here. The massive NAR settlement. The National Association of Realtors got absolutely hammered in court back in 2024 regarding their commission structure.
That was a true seismic shift for the industry. That standard 6% commission that was practically baked into every single home sale in America for 50 years, it's gone. Or at the very least, it's been totally decoupled.
So suddenly, paying a flat service fee to Opendoor looks very, very competitive compared to the old traditional model where you basically had to surrender 3% to your agent and 3% to the buyer's agent off the top.
Exactly. It finally leveled the playing field for alternative models. In fact, Opendoor is now actually partnering with traditional agents. In the past, agents viewed Opendoor as the enemy and hated them. Now, smart agents are using Opendoor as a back-end tool to guarantee their clients a quick sale when they need it.
Okay, so the broader market is coming back. They have the definitive brand name, and the regulatory environment is heavily favoring them.
But I want to drill down on the tech part of PropTech. Everyone and their mother claims to be an AI company right now. Is Opendoor actually using artificial intelligence, or is this just marketing fluff to pump up the stock price?
In this specific case, I would argue it's incredibly real. And it's real primarily because of the proprietary data. Opendoor has 10 years of highly specific transaction data. They haven't just scraped public Zillow listings like everyone else. They have actually physically bought and sold tens of thousands of homes. So they know things that the public county data just doesn't show.
They know exactly how much a specific physical renovation, say, replacing cheap laminate kitchen counters with high-end quartz in a very specific zip code in Phoenix, Arizona, will affect the final sale price.
And they know exactly how long it takes to get the contractors to do it.
Down to the specific day. If you are a brand new tech startup trying to build a pricing algorithm today, you are essentially just guessing. Opendoor is not guessing. They have already paid the tuition in the form of those massive past financial losses. They possess the ground truth training data.
That is a fascinating point. The catastrophic financial losses of the past are basically just the incredibly expensive R&D budget for the AI models of today.
That is certainly the charitable bull case way to look at it, yes. But it is structurally true. A new startup simply cannot replicate that data set without going out and losing $1 billion first to gather it.
So they have a legitimate moat. But moat doesn't really matter much if the castle itself is currently on fire. We need to talk about the people actually running this place, because this refounding requires some very serious, unsentimental leadership.
Chapter 2, Management Evaluation.
This is where the human element really comes into play.
Yeah.
We have a company here that lost roughly 97% of its total value from its all-time peak. Most normal CEOs would have parachuted out long ago, or they would be hiding under their desks hoping nobody notices them. But Opendoor has Kaz Najatian.
Kaz is a truly fascinating corporate character. He took over the CEO role relatively recently, stepping up from the COO position. But his core background isn't in traditional real estate at all. It is pure tech. He was a high-level executive over at Shopify for years.
And Shopify is widely known for having a very specific, intense corporate culture. Very driven, very ruthlessly efficient.
Unsentimental is the exact word I would use for him, and he brought that exact energy straight to Opendoor. There's a great quote in the report we read where he proudly describes himself as anti-consultant.
I absolutely love that phrase. What does being anti-consultant actually mean in practice for a billion-dollar company?
It means when things got really bad in 2024 and 2025, he didn't run out and hire McKinsey or Bain to tell him what to do with a PowerPoint presentation. He fired the existing consultants. He cut deep into the bloated middle management layers, and he forced a very strict return-to-office policy because he fundamentally believed the remote culture had gotten far too lax for a company fighting an existential crisis.
It sounds like he was putting the entire company on a strict war footing.
He absolutely was. And he consciously changed the internal and external language. He flat out refuses to call this a turnaround. He mandates it be called a refounding.
That is a very important psychological distinction. A turnaround implies you are just polishing up the existing car and fixing the engine. A refounding implies you are stripping the whole thing down to the bare chassis and building a totally different vehicle.
Exactly. He's essentially telling the market, look, we are a startup again. Yes, we have physical assets. Yes, we have a great brand, but we are building a brand new company from scratch today. And a huge part of that new company culture is radical honesty.
Transparency. I was really struck by a quote from his recent shareholder letter. He literally wrote, "We can no longer charge high spreads and hope the macro saves us."
That is so refreshing, isn't it? Usually when a public company misses its earnings, the CEO gets on the call and blames the weather, or they blame interest rates, or the upcoming election. Kaz is standing there saying, no, our legacy model was fundamentally flawed. We were essentially gambling on rapid home price appreciation, and we are officially stopping that right now.
He is taking full ownership of the reality. And they have put a very hard public target on the wall for everyone to see. Adjusted net income break even by the absolute end of 2026.
That is the definitive finish line. If they cross it, the company survives and thrives. If they don't, things get very, very ugly for everyone involved.
But talk to me about the warrant dividend. This is the specific part of the management section in our sources that really made me sit up and pay attention. This feels like an absolute masterclass in corporate behavioral economics.
It is genuinely brilliant structuring. So take yourself back to November 2025. The stock was sitting in the absolute dumpster. Long-term shareholders were furious. The company certainly didn't have spare cash lying around to pay a normal cash dividend. So what did Kaz and the board do? They issued special warrants to all existing shareholders.
Okay, let's break that down for the audience. What exactly is a warrant in this financial context?
A warrant is basically a financial coupon that gives you the legal right to buy the company's stock at a very specific preset price sometime in the future. They set 3 different strike prices for these warrants: $9, $13, and $17.
Hold on, let's put that in perspective. At the time they issued those, the stock was trading at what, like $2 or $3 a share?
Exactly. So management hands you a piece of paper that legally says you have the right to buy this stock for $17. And you are looking up at the stock ticker and it says $3. Your immediate thought is, this is a completely worthless piece of paper. Why would I pay $17 for something I can buy for $3 today?
It is like someone handing me a coupon that gives me the right to buy a fast food burger for $50. Thanks for absolutely nothing.
Right, unless the stock goes up dramatically. If the stock eventually rallies to $20, that $17 warrant coupon is suddenly worth a real $3 in pure profit. If the stock goes to $50, that warrant is worth an absolute fortune.
Oh, I see. So it is a total burn-the-boat strategy for the company.
It perfectly aligns every single person.
Hmm.
The management team holds massive amounts of these warrants, too. They only get a big payout, and the loyal shareholders only get a reward if the stock essentially triples or quadruples from the bottom. If the stock just stays flat at $5, the warrants expire completely worthless, and nobody gets a dime.
It creates a purely binary outcome. Either we win incredibly big together, or we get nothing. There is no mediocre success option allowed here.
Which is exactly the mindset you want during a refounding. You want a leadership team that is forced to swing for the home run fences because hitting a safe single does not help you survive when you have this massive amount of corporate debt hanging over you.
Speaking of that debt and some truly bad math, we have to eat our financial vegetables now. The Deep Value Report brings up two very specific acronyms, ROIC and WACC. Now, I will admit, usually my eyes completely glaze over when analysts start throwing these around, but you told me right before we started recording that this specific calculation is the absolute smoking gun of the whole story.
It really is. It is the undeniable mathematical proof of why the old legacy business simply had to die.
Okay, explain it to me like I am 5 years old.
Okay, let's keep it simple. ROIC stands for Return on Invested Capital. It is essentially a measure of how much actual profit you generate for every single dollar you pump into the business engine. WACC stands for Weighted Average Cost of Capital. That is simply how much it costs you in interest and fees to acquire that dollar in the first place.
So it's just cost versus return. Simple enough.
Right now, Opendoor's cost of capital, primarily because they are carrying so much debt, and the broader market views them as incredibly risky, is currently estimated at around 27.5%.
Whoa, 27.5%. That is not corporate debt. That is basically credit card interest rates.
It is wildly unsustainably expensive money. Now look at their ROIC, their actual return. It is -9% to -10%.
So let me make sure I have this perfectly straight. They are actively borrowing money at 27% interest just to turn around and lose 9% on it?
That is the literal definition of systemic value destruction. Under the old legacy model, the faster they tried to grow and buy houses, the more shareholder money they mathematically destroyed. It is exactly like intentionally selling dollar bills for 90 cents and borrowing money at loan shark interest rates to fund the operation.
That puts the whole refounding narrative in a terrifying new perspective. It is not just that they want to pivot to a software marketplace model because it sounds cooler. They literally have to.
It is a pure existential necessity. You simply cannot run any business on planet Earth where your cost of capital is 30 percentage points higher than your return. The cash plus model, where they just facilitate and don't actually use their own expensive capital to hold assets, is the only logical way to escape that fatal math trap.
So the broad strategy makes total sense. But having a good strategy on a whiteboard is one thing. The actual bank account balance is another.
Yeah.
Let's look at the actual financials they just reported.
Chapter 3. Financial health.
We looked closely at the top-line revenue numbers for 2025, and they're surprisingly small. Back in 2022, this company did roughly $15 billion in revenue. In 2025, just $4.37 billion. That is a massive cratering of the business.
It certainly looks like a total collapse on paper, but context is absolutely everything here. That massive drop in revenue was entirely intentional. Remember how the accounting works in the old iBuyer model? Their reported revenue is literally just the final sale price of the homes they sell. If you intentionally stop buying homes because the market is crashing, you obviously stop selling homes.
So they purposely shrank the company just to survive the storm.
They slammed both feet heavily on the brakes. They smartly prioritized corporate survival over chasing vanity metrics like top-line revenue growth.
Okay, so the revenue's down on purpose. We get that.
Yeah.
But they still lost a ton of money. The reported net loss was $1.3 billion last year.
That headline number is definitely scary, but we need to put a very massive asterisk right next to it. About $933 million of that total loss was actually a one-time non-cash accounting charge directly related to refinancing their old debt.
Okay, so it wasn't actual physical cash flying out the door to pay bills. It was essentially accounting cleanup on the spreadsheet.
Exactly. It's a paper loss. But to be fair to the Bears, even if you completely strip that specific charge out, they are still operationally losing money day to day. They are not a profitable enterprise yet.
And their profit margins are just razor thin. The gross margin is sitting at 7.7%. But the metric that really scares me in this report is the contribution margin.
Contribution margin is the absolute key to understanding their unit economics. That is the actual profit left over on a house after you pay all the direct variable costs, the holding costs, the real estate agent fees, the minor repair costs. In Q4, that margin was exactly 1.0%.
1%. So if they go through all the trouble of buying and selling a $500,000 house, they only make $5,000.
Yes, and that is before paying their corporate staff, their office rent, their high-priced software engineers, and their national marketing budget. That is barely a margin of error. If they estimate the carpet repair costs wrong by just a little bit, that 1% vanishes instantly and the house becomes a net loss.
Which naturally brings us to the balance sheet itself. They are carrying $2.3 billion in total debt. That is a very heavy backpack to wear while you are trying to run a corporate sprint.
It is incredibly heavy. And there is a hidden trap in the balance sheet numbers here called the current ratio. If you just glance at the summary spreadsheet, it says their current ratio is a very healthy 5.67. Normally in finance, anything over a 2 is considered great. It means they technically have 5 times as many short-term assets as they do short-term debts.
So on paper, they look incredibly flush with liquid assets.
But you have to look deeper at what those assets actually are. Fully $925 million of that asset column is simply categorized as real estate inventory.
Which means physical houses.
Houses. You cannot pay a sudden bank loan call with a 3-bedroom colonial house in the suburbs of Atlanta. Not quickly, anyway. If they face a sudden liquidity crisis, they can't just swipe a split-level ranch like a Visa card. They have to actually sell it. And in a down housing market, clearing that inventory takes many months.
So their true usable liquidity is much, much tighter than that 5.67 ratio suggests to a casual observer.
Considerably tighter. They are very cash-constrained in reality.
And then there is the cash flow paradox. I always get completely tripped up on this concept when looking at iBuyers. The report states they had positive cash flow of about $1 billion in 2025. That sounds objectively great to me.
It sounds fantastic, but it is unfortunately a total mirage. For an inventory-heavy iBuyer, generating positive cash flow usually means the company is actually shrinking its operations.
Walk me through the mechanics of that.
Think about the physical inventory cycle. To grow the business, you have to continually buy more houses. Buying houses requires massive amounts of cash. So a healthily growing iBuyer inherently burns cash every quarter. But if you stop buying new inventory and just sell off everything you already hold,
then the cash floods back into the bank account from the sales.
Exactly. So that $1 billion of positive cash flow did not come from operational profit. It came from forced liquidation. They were just turning their existing houses back into dollars and consciously choosing not to replace them.
So you obviously can't do that trick forever. Eventually, you just run out of houses to sell.
Correct. You shrink your way to zero. That is precisely why the rapid transition to Cash Plus is so vital for their survival. They desperately need to find a way to generate actual free cash flow while still growing transaction volume. If they can start collecting those 35% service fees without buying the physical houses, they finally solve the paradox.
Okay, so summarizing part 1 here, we have a business that is pivoting hard, a management team that is financially all in, and underlying financials that are undeniably messy but logically explainable. That brings us to the halfway point of the deep dive. We've looked under the hood at the engine. Now we need to look at what the rest of the financial world actually thinks about this car.
Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion.
Chapter 4, Market Sentiment.
Wall Street absolutely hates uncertainty, and Opendoor has been nothing but pure uncertainty for the last 3 years straight. The broad consensus recommendation from analysts has basically been, run away as fast as you can.
Yeah, seller hold ratings practically everywhere you look. It has been a massive show-me story. Analysts have been crossing their arms, sitting back and saying, show me you can even survive the year. Show me this software pivot actually works in the real world.
And the assigned price targets perfectly reflected that deep skepticism. Most major investment banks had the stock firmly pegged right around $4.30.
But something clearly shifted this week. We mentioned the massive stock pop today, February 20th. But it's not just the retail price action. The big institutional banks are actually changing their tune on the stock.
Who specifically is moving their targets?
Well, UBS just raised their target from a devastating $1.60, which is basically them predicting imminent bankruptcy, all the way up to $5. And Morgan Stanley went even higher, upgrading their target to $8.
That is a truly massive vote of confidence from major players. Going to $8 implies roughly a 60% upside from where it was trading.
They are clearly starting to believe the refounding narrative. They are seeing that 35% cash plus volume growth and thinking, okay, maybe the fundamental math of this business is actually changing.
And the clear catalyst for this shift was the Q4 earnings report that was just released yesterday. Top-line revenue solidly beat their estimates, coming in at $736 million versus the expected $594 million. But the underlying stat that really caught my eye was that home acquisitions jumped 46% quarter-over-quarter.
That is the ultimate growth signal. For the first time in years, they are finally stepping back on the gas pedal. They are financially confident enough in their new models to start buying again.
And because they beat those low expectations so soundly, we are seeing a very classic market reaction today. But is there more to this aggressive 16% jump than just a good earnings beat? We hear the financial term short squeeze thrown around a lot on social media. Is that happening here?
It is very relevant to what we are seeing today. The short interest in Opendoor is sitting at about 14.5% of the total available float. That means 14.5% of all the available shares have been actively sold short by traders, making a bet that the price will continue to go down.
How does that specific percentage compare to their industry peers?
Most of their peers are usually hovering right around 6% short interest, so the active betting against Opendoor is more than double the normal industry average.
So the market was incredibly crowded with loud bears.
Exactly. And when surprisingly good news hits, like this revenue beat, those short sellers start to panic. They are forced to buy the stock back on the open market to cover their losing positions and stop the bleeding.
And their forced buying inevitably drives the stock price up even higher, which then scares the next level of short sellers.
Who then also have to buy. It creates a violent feedback loop. That is exactly why you see these massive sudden moves like 16% in a single morning. It is not just excited investors buying, it is terrified skeptics fleeing a burning building.
I want to briefly touch on the technical analysis for a second. I know reading charts is considered voodoo to some fundamental investors, but the moving averages do tell a psychological story. The price right now is $5.40. Where does that sit historically?
It is sitting right in a major technical battleground. The current price is technically below the 50-day moving average, which usually signals that the short-term trend is still quite bearish. But crucially, it has broken above the 200-day moving average.
And the 200-day average is considered the long-term trend indicator.
Right. Being back above the 200-day suggests that the long-term, multi-year bleeding has finally stopped. The stock is actively trying to build a solid technical base to climb higher. It visually confirms that the absolute bottom is likely in the rear-view mirror.
So the day traders are violently fighting it out on the charts. But who actually fundamentally owns this company? Because if I am considering buying shares to hold, I want to know exactly who is sitting at the poker table with me. Are the big institutional boys involved?
Chapter 5. Ownership structure.
We always look for the smart money, right? The massive institutions. Are they actively buying more, or are they quietly fleeing for the exits?
They are actively buying. The top 25 holders currently own roughly 50% of the entire company. Vanguard holds about 11.6%. But the specific institution that really stands out to me in the filings is Morgan Stanley.
What exactly did they do recently?
They own about 5% of the company right now, and they recently increased their total position size by over 500%.
A 500% increase. That is not just a casual rebalancing bet. That shows extremely high conviction in the thesis.
You simply do not increase a position by 500% unless your analyst firmly believes something fundamental to the core business has permanently changed for the better. They are clearly betting heavily on the refounding.
And then you also have strategic industry partners holding shares, like Lennar Corporation. Lennar is one of the biggest traditional home builders in America, and they own about 2% of Opendoor.
That is super interesting because it suggests major potential future partnerships. Imagine if Lennar officially used Opendoor's platform to seamlessly help their customers sell their old homes so they can smoothly buy brand new Lennar construction. There is massive synergy there.
But my absolute favorite ownership indicator is always the insider buying. We talked extensively about the warrants, which are technically forms of compensation, but are the executives actually going into the open market and buying stock with their own cold, hard cash?
They absolutely are. CEO Kaz Najatian recently bought $1 million worth of common shares on the open market in late 2025. Co-founder Chung Wu went even bigger, buying roughly $5 million worth.
Now that is what we call truly eating your own cooking.
Exactly. There is really nothing that speaks louder to investors than an executive writing a massive check from their personal bank account. It tells you they genuinely believe the current stock price is deeply undervalued.
Now, I do have to play devil's advocate for a minute. I saw a scary headline recently about the CFO, Christy Schwartz, selling a chunk of shares. That type of headline usually completely freaks retail investors out. They see it and think, oh no, the CFO knows something bad and is dumping stock. We need to abandon ship immediately.
Yes, we definitely need to clarify that. Context in SEC filings is critical. That specific transaction was plainly marked as a sell-to-cover transaction.
Translate that corporate jargon for us.
When high-level executives get their stock grants as part of their regular pay package, they owe standard income tax to the IRS on that value immediately. But they don't necessarily have the raw cash sitting around to pay that massive tax bill. So the company's automated system simply sells just enough of the granted stock to cover the tax liability.
So it wasn't a sudden lack of faith in the company. It was just the IRS automatically taking their mandatory cut.
Exactly. It was a completely routine, automatic administrative sale.
Yeah.
If she was actively dumping 50% of her total vested holdings, I would absolutely be worried. This was just paying the tax man.
Okay, that is really good context to have. So the major institutions are heavily buying, the insiders are actively buying, and the CFO is just paying her routine taxes. It all sounds incredibly positive so far. But this is our deep dive, and we don't just do cheerful puff pieces here. We have to thoroughly examine the downside risks. And there's a brand new macro risk that I really hadn't considered until I read the specific report, and it honestly scared me quite a bit.
Chapter 6. Risk Assessment.
Let's start by briefly summarizing the standard stuff. The classic SWOT analysis. Strength. Massive scale and proprietary AI data. Weakness. Zero annual profit and a huge debt burden. We know all that. But the severe threat that caught my eye is specifically the tariffs of 2025.
Right. This is the new potential black swan event. In early 2025, the U.S. government officially imposed steep 25% tariffs on various goods imported from Canada and Mexico.
Okay, geopolitical trade policy. Usually that feels miles away from software and real estate. Why does a tech-enabled real estate company care so much about bilateral trade with Canada?
Because of exactly what we import heavily from Canada and Mexico. Softwood lumber, processed aluminum, gypsum drywall.
Oh. The exact raw materials that houses are physically made of.
Precisely. Opendoor, at its core legacy level, flips physical houses. Even their so-called light renovations heavily require fresh paint, new flooring, and replacing damaged drywall.
Okay, let's do the hard math on this new tariff threat, because this is exactly where that razor-thin 1% contribution margin comes back to severely haunt them.
Right. The National Association of Home Builders recently estimated that these specific 25% tariffs will add between $7,500 and $22,000 to the total cost of a typical residential home renovation.
Okay, hold on. Let's just take the absolute low end of that estimate to be conservative. A $7,500 increase in direct repair costs.
Okay, let's run this scenario.
We established earlier that Opendoor's average contribution margin is sitting right at 1%. So on a typical $400,000 house, that equals exactly $4,000 in operational profit.
Correct.
So if the total expected profit is $4,000 and these new border tariffs suddenly add an unavoidable $7,500 to the repair costs,
then you have instantly lost $3,500 on that transaction.
Yeah.
Instantly.
That math effectively wipes out the entire legacy business model overnight.
It absolutely wipes out the legacy physical business. If basic renovation material costs spike that hard, their physical house flipping operation becomes completely mathematically unviable. They cannot simply pass that massive extra cost onto the next home buyer because the local housing market is too competitive. And they can't offer the initial seller $7,000 less for the house up front, because the seller will just say no and go use a traditional agent.
They get completely financially squeezed in the middle. This stark reality makes the urgent pivot to the 2.0 software model even more absolutely critical. If they just facilitate the sale and don't physically own the house, they never have to pay for the expensive imported drywall.
Exactly. The geopolitical tariffs are dramatically accelerating the desperate need for Opendoor 2.0 to succeed quickly. If they stay as a traditional iBuyer, the tariffs could literally crush them into bankruptcy. If they successfully become a digital marketplace, the tariffs matter significantly less because either the seller does the repairs themselves or the new buyer simply takes the property as is.
So these 2025 tariffs are basically acting as a ticking time bomb. It is literally pivot or die for the management team.
Pretty much. And of course, hovering above all of this is the old familiar enemy: broad inflation and federal interest rates.
Right. If broad domestic inflation suddenly spikes back up because of these sweeping tariffs, the Fed might be forced to hike interest rates aggressively again.
And if mortgage rates go rocketing back to 8%, that devastating lock-in effect immediately returns, total transaction volume completely dries up across the country, and we are right back to square one. Opendoor absolutely needs high transaction volume to survive. They need the housing market to remain fluid and moving.
So we have a fascinating company with huge disruptive potential, but also carrying truly massive existential risks. And this extreme duality is perfectly reflected in their current stock valuation. I teased this wildly diverging model at the very beginning of the show, but let's finally dig into the DCF debate. Discounted cash flow.
This is where all of that qualitative uncertainty manifests directly into hard numbers.
Hmm?
A DCF model attempts to value a company today based entirely on its projected future cash flows. But because Opendoor's future outcome is so incredibly binary, they either thrive as a platform or die as a flipper. The financial models are just wild.
The primary bear case DCF heavily focuses on the risk, right? They use a very high discount rate.
Yes, the bear case firmly assumes the execution risk is extremely high, so it plugs in that brutal 27% cost of capital we discussed earlier. It assumes sluggish market growth, continued struggles with a massive debt load, and severe margin compression from the tariff trouble. That pessimistic model spits out a final fair value of exactly $4.33 per share.
Which is obviously below where it is currently trading today. So the bears are confidently saying the stock is still fundamentally overvalued, even down here.
Correct. But then you look at the bull case DCF. The bull case assumes the AI-driven pivot to cash plus works beautifully. It assumes profit margins rapidly expand because software marketplaces are highly profitable. It assumes the corporate risk profile drops significantly, so they apply a much lower standard 9% discount rate,
And what does that highly optimistic model give us for a price?
$150 per share.
$4 versus $150. That wide of a spread is the absolute textbook definition of a high-risk, high-reward generational play.
It perfectly represents the canyon-sized gap between becoming a bankrupt home flipper and becoming the undisputed Amazon of real estate. The entire stock market is currently fighting to figure out which exact path this company is on.
So what does this massive amount of data actually mean for us watching from the sidelines? Let's finally wrap this all up.
Chapter 7.
We have thoroughly looked at every angle of the refounding of Opendoor. The core bull thesis is actually pretty straightforward. Opendoor 2.0 is fundamentally working. Cash Plus already represents 35% of the business and is growing fast. The new management team is heavily financially aligned with those aggressive $17 warrants. The broader real estate market is visibly thawing out, and the surprise Q4 earnings prove they can actually step on the gas and move fast again.
And the bear thesis is arguably just as clear and compelling. They have never once been profitable on an annual basis. The $2.3 billion in corporate debt is still deeply suffocating, and these brand new geopolitical tariffs on raw materials like drywall and lumber could completely wipe out their already razor-thin margins on the legacy physical business literally overnight.
The stock is actively trading right around $5.40 today. That represents roughly a 25% premium over that conservative $4 valuation model. The market as a whole is placing a very real bet on the comeback story.
It is. They're willingly paying a premium strictly for the possibility of the refounding working out.
It really feels like the next 12 months are the whole ball game here. If they actually hit that stated profitability target by the end of 2026, the bulls win massively. If the material tariffs bite hard and they miss it,
Then the bears win, and those special warrants expire, completely worthless.
I want to leave everyone listening with one final, broader thought here. We constantly hear analysts casually compare new tech companies to Amazon. You know, they are the Amazon of this or the Amazon of that. But really think about Amazon's history for a second. For years and years, they were just an online bookstore that aggressively lost money every single quarter. Everyone on Wall Street confidently said they are just shipping heavy, low-margin books. The shipping cost will eventually kill them.
Right. They said the exact same things about the margins.
But Bezos wasn't just building a digital bookstore. He was methodically building a global logistics layer. They were building the underlying invisible infrastructure of modern commerce.
And the most compelling argument for Opendoor is that they are quietly building that exact same type of foundational liquidity layer for the massive U.S. real estate market.
Exactly. If they actually succeed with this pivot, they aren't just flipping houses anymore. They permanently become the essential digital plumbing that every single future house sale in America flows directly through. If they fail, well, they end up just being a highly leveraged bank sitting on a lot of very expensive drywall and some really bad debt.
And the definitive difference between those two wildly different outcomes will very likely be decided by exactly how well Kaz and his team navigate this treacherous new tariff minefield throughout the rest of 2026.
It is undoubtedly going to be a truly fascinating year to watch this story unfold. Thank you for diving so deep with us today.
This analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions.